folks. Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you with a brief market update today, kind of let you know what's going on out there. S&P 500, as I speak, is right around 3970. We're right around that sort of 4,000 level that we've been talking about for quite some time now. That's not to say that the market's not volatile. We've seen a number of days recently with, plus or minus 1% to 2% movements in either direction. Market clearly has a lot of volatility in it, a lot of jitter, a lot of fear, if you will, combined with greed. As we've talked about previously, when we get into these market times, it's more important to focus on an absolute level for the S&P 500 as opposed to a percentage change. You can drive yourself nuts trying to keep track of up, down, etc. The 10-year Treasury is at 2.75%, which is a little bit down, actually. And something we're going to talk about later on in this update is interest rates and how they move. But I think it's worth noting that interest rates have actually come down a little bit since the last time we spoke, call it 20 to 30 basis points or 2 to 0.3%. Which is going to be important later on. A couple of changing narrative points that I just want to talk about where we were at the beginning of the year versus where we are today. First thing is interest rates are not really well understood, and it's a technical topic. But when the Fed comes out and announces that they're going to raise rates, and sort of puts forward a dot plot, puts forward an expectation for where they are going to be raising rates over time, the short-term interest rate that the Fed controls, literally the overnight interbank rate, doesn't move until the Fed raises rates. So we raised it 50 basis points or 0.5% earlier this month. Looks like the next meeting, the expectation is that we'll raise it another 0.5%. And if you look at forward expectations or predictions in the marketplace for where that goes, we get up to about 3% as a terminal rate. Those predictions already get incorporated in the 2-year, the 5-year, and the 10-year yield. And in fact, the 5-year yield is now at 2.75%. And then the 10-year Treasury spiked all the way up north of 3 before receding a little bit. The thing that I think is important about that is there are a lot of interest rates in the economy or interest payments in the economy that are tied to the 2, the 5, the 10, the 30, and not necessarily to that interbank rate. In fact, most people wind up financing things based on longer term interest rates as opposed to short term interest rates. The United States is a little unique in that way. Most in Europe, most things are done on floating rate loans. In the United States, most things are done with fixed rate loans. And that's my very simple way of explaining that a lot of the slowdown that the Fed is trying to create is already out there in terms of where the 2 and the 5 and the 10-year interest rates are. If you have looked to refinance a mortgage recently or make a mortgage purchase, you would notice that mortgage rates have already spiked. Which is a little bit of a good thing. If you're thinking about, economic activity already seems to be slowing down a little bit and the Fed just started raising rates. That's because while the Fed has just started to raise rates on the very short term, rates along the curve have already risen, and that already has a pretty significant dampening effect on the economy. So that's point one that I think is important to understand. The second thing that I think is important to understand is that if we are to cool off inflation, we do need to see some demand destruction, right? So I like to use the analogy of cars. If there are 100 people that want to buy cars and there are only 60 cars on the lot, you're going to get inflation in new car prices because those 100 people are going to bid against each other until 40 of them decide that the price is too high. And that's how you wind up with going down to your local Ford dealership to buy a Ford Bronco and being told it's a 6-month wait and you need to put down a $5,000 deposit and pay a couple $1,000s over sticker. That's not good for inflation. We want to see that cool down. The Fed was hoping a year ago that the supply chain would just solve that problem by making it so that there were 100 Fords on the lot, not 60. The reality is the supply chain hasn't been able to catch up. So instead, on the demand side, we need to make it so that there are only 60 people that want to buy cars, not 100. And the result of that, just so we're all clear, is that Earnings reports where companies come out and talk about maybe a little bit of softness in demand. Maybe a report out of Ford that talks about inventories building up on people's balance sheets. What we're starting to see in the housing market in terms of supply, a couple of days of inventory moving back towards more normalized parameters. That's actually a good thing. That's what we want to see as we're looking to tame the demand beast. It's yet to be seen whether or not we overshoot, right? We don't necessarily, we want to convince 40 people not to buy cars, not 60 or 70 people not to buy cars. But we do have to make everyone slightly less excited to spend money in order to tame the inflation beast. And that's the goal. So I know that's a nuanced point, but it's one that's important to understand when we get some of these earnings reports that we've seen recently out of Target and Walmart and a couple other retailers that have talked about a little bit of either softness in the consumer or changing consumer preferences. That's actually a positive as we think about controlling the inflation narrative, not a negative. Last, I would just comment that the market has kind of pivoted from oh my goodness, interest rates have moved from 1% to 3%. That means I need to change my discount rate and move multiples down and valuations down around the curve towards more of I'll say concern around, are we going to get a soft landing? Is the Fed going to be able to cool off the economy to the point where inflation is under control without a recession? Or are we going to get what's known as a hard landing, which is, the Fed overshoots, cools off the economy too much, and we wind up in a recession? And the reason why that's important is when the concern in the market is just purely rising interest rates, then you wind up with sell-offs in both bonds and stocks, right? So those of you who are watching your portfolios this year, you'll notice that bonds sold off in addition to equities. Recently, the recent market weakness, which has been driven more by concern about earnings or concern about are we headed into a recession or not, actually reestablishes that inverse correlation that's important in portfolio construction, as evidenced by the fact that in the past couple of days, when stocks have sold off over earnings concerns or economic activity concerns, bonds have actually rallied on the other side of it. And those of you who are paying very close attention to your bond portfolios will see that fixed income prices are actually moving inversely to stocks as we get these concerns out of recessions. And that's a great thing from a portfolio construction standpoint. It means the portfolios behave exactly as we want them to as we get into concerns over recession. So in any event, as always, if you have any questions about this or anything else, please feel free to reach out to either myself or to your advisor. I hope you're having a great week, and I look forward to coming to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.